If you own companies like Nebius, like CoreWeave, like Oracle, the past 5 days have pretty much sucked. As we can see, these three companies, which are dealing in the AI infrastructure market, are down a nice amount. Oracle down roughly 10%, CoreWeave down over 10%, and Nebius down over 20% in the past 5 days. Now, in recent comments, I keep getting asked, Jose, are you planning on buying any of these? Are you planning on adding CoreWeave? If not, when would you buy more into these players? I'm going to explain a little bit more of how I feel about these three companies and just the overall AI infrastructure market that they hit. So let's take a closer look in today's episode.
I want to thank the Motley Fool for sponsoring this video, and check out fool.com/Jose for the 10 best stocks to buy now. With that link, you get a promotional offer for their subscription service. Now, let's continue with today's episode.
All right, so if you're not familiar, this channel really focuses on AI and semiconductor market. Now, for me, the AI infrastructure market is one that has various growth opportunities, especially thanks to the demand of massive compute that is needed for the next innovations in the AI era, being robotics, via video generation, image generation, AI agents, and the list goes on and on. Now, there are a lot of players in this list, but the overall market trend for me is very, very bullish. That doesn't mean, though, that every stock is a buy in my list. Right, we kind of have a three-tier, in my opinion, a three-tier system. You have kind of like your hyperscalers, which are your Mag 7s. You have your Google Cloud, your Amazon AWS, and your Microsoft Azure. Then below that, you kind of have the growth players that have great deals at the moment, but still have a lot of competition. These, in my opinion, are the ones that are the perfect risk to reward ratio. In my opinion, these are your Nebius, your CoreWeave, right? These are companies that are kind of starting off in this deal, in this market, but have already great backings. Nebius has that great deal with Microsoft. CoreWeave has a lot of deals with companies like Meta, with Microsoft, with OpenAI. And then you have Oracle, which is a bit bigger than these, but it's also just really starting to get its ground up in the AI infrastructure revenue space. It has a lot of great companies like XAI, OpenAI with Stargate, and the list goes on. Then, so that's tier number 2. Tier number 3, in my opinion, is a lot of these neo clouds that are either Bitcoin miners turned into hyperscale players or changing their business a bit. Now, I'm not saying those are bad investments, as I think it's all about risk to reward and risk to being right. With those markets there, you have the opportunity to have extreme multi-baggers, but the risk of picking the right one is extremely, extremely high, in my opinion. So while I do talk about some of them, for the big portion of my overall portfolio where I feel a lot safer due to the backing of the business, it is definitely these three players. I would love to know in the comments below, what are your 3 players or 4 or 5 players that you're really focused on here in the AI infrastructure that you believe have the best risk to reward ratio? All right, so now I broke it down. Ecosystem, I'm very bullish. In the overall ecosystem, we can break it down into those 3 tiers. I like tier 2 in forms of my overall investment for growth opportunities. I still invest in tier 1. Tier 1s, I own companies like Google, and tier 3s are more like the YOLO plays, in my opinion. Now, in form of these three have taken a huge hit. Which are the ones I'm more excited about? I'm going to start off with my lowest excitement, and that would be Oracle. And I'll explain why in a bit, but I'm just going to give you the list for me. The least excited that I am right now is Oracle, even with the price drop. The one that I'm second least excited with the price drop, or the one that I'm more excited, maybe if that's the case, the second excitement that I have right now of growth opportunities or buying opportunities is CoreWeave. The one that I think investors or I'm the most excited about this recent drop is Nebius. This is number 1. And again, I'll explain a little bit more in today's episode. But let's start off here with Oracle and why this is my third favorite out of the 3 and why I'm personally not buying much of this one, if any. Now, Oracle, historically, if we look at it, this chart's produced by Fiscal.ai. Check out Fiscal.ai/Jose for 15% off. I use this platform on a daily basis. If you're a long-term investor, This is the platform you need. I personally think is cheap and I use it every single day. Now, Oracle's, the orange, historically has traded at very low valuations and very low valuations that in a video that I did almost 2 years ago in January 6th of 2024, I talked about my top 3 AI stocks for 2024, NVIDIA, Oracle, and CrowdStrike. Now, the reason I talked about Oracle was it had various growth opportunities in the AI infrastructure, and that's sitting here right now, January 2024. It had various growth opportunities in the cloud space, and it was trading at a cheaper valuation than Google at one point, right? And Google was one company that historically trades very cheap and much cheaper than one of the big players, Microsoft, right? So you had the growth opportunity there, and you also had this mispriced in valuation. Now, fast forward to 2025, the story, in my opinion, has changed. I believe the growth opportunity is still there. But if we look at valuations now, which is the orange, both Oracle and Microsoft, which historically trades at a higher valuation, are trading very, very similar. Now, the other opportunity, which is the mispriced, is shifted around. It's not there anymore. So now, because it's not there anymore, that increases my risk. So while I do believe the growth opportunity is there, the opportunity of being an extremely multi-bagger from here has decreased a bit. And I believe it's more of a market beating stock opposed to a multi-bagger beater, right? So that's the difference. I still own some Oracle, but it's not the one I'm most excited about. Now, luckily, if you are an investor of Oracle, they just had a financial analyst event, and you can go to their investors relations presentation. You can go to October 16th. You can even look at the presentation slides. They have all these different players. The one that you're most likely going to be most focused about is the Oracle Cloud Infrastructure. You can watch the 40-minute video, or you can kind of get the PDF file. Now, they talk a lot about their overall market opportunities, but the things that I got the most excited about and that investors should know is this. During the 30 days in Q2, they contracted about $75 billion in infrastructure as a service total contract volume. That's pretty high. That's about 2.2 over 2 billions per day. And they also upgraded their long range revenue plan for Oracle Cloud. For fiscal year of 2026, which is where we're at right now, they still expect that 18 billion. But for fiscal year 2027, they increased from 32 to 34. And they did some various growth throughout the next few years. Now, as a long-term investor, I personally wouldn't value a stock based on 5 years from now, right? I think 2 years from now is better off because anything after that, anything can happen in this AI market. So with that I think the growth opportunity is still market beating, but I don't know if it's a multi-bagger, especially with all the excitement that the stock has come up with. Now, another slide, and I liked really much from Oracle is they talk a lot about this is another cool one here. They talk about some of the companies that they're working with to build out these massive data centers. I personally don't follow them, but if anyone is bullish on any that are public, obviously in the hardware space, I follow NVIDIA, AMD. But in the energy space, I'm not familiar with Volta Grid, Orion, or in the DC, I'm not Vantage, S-Stack, Infrastructure, Related Digital, or Crusoe. I'm not familiar with them, but if any of them are public and you guys have any bullish thoughts on them, let us know in the comments below. Now, this is something that investors should know. There was not a hit piece, but a negative release on Oracle that they were doing really bad in AI infrastructure. But the reason being is AI infrastructure is spending a lot of money right now, but it's better if you look at it in a long-term view. So this is an example that, let's say you put $10 billion you spent $6.4 billion in cost of acquiring land, data center, compute, chips, networking chips, storaging solutions. You spend $6.4 billion for the next 5 years, 6 years. You're going to spend about $39 billion. Within those 6 years, you're going to make revenue of roughly $60 billion. Now that $60 billion is going to give you a gross margin of roughly 35% or 21 billion. So in this market that is vastly spending a lot of money on capital expenditure, it's very hard to look at gross margins on a single point basis because you have to look at the long tail of things. And this could create a lot of hiccups and noise in the overall AI infrastructure market, where one quarter you can be like, oh man, margins are horrible, and we see kind of an overall reaction to the stock price. Now, Oracle is my least favorite. Now, some might say, Jose, when are you excited to buy Oracle? Now, for me, I'm horrible at giving stock price targets, right? I'm not a person to give stock price targets. If I'm bullish in the company, there's three things that I do. I either small dollar cost average, medium dollar cost average, or heavy dollar cost average. For me, Oracle is one that at the moment, it would be very much a small dollar cost averaging, just adding little bit by little bit here and there. The only time I would maybe shift to maybe a little bit more aggressive approach is if I see the valuations be a lot lower than Microsoft. And I would expect that to happen if the stock drops below 260. Now, again, I'm not saying the stock price is going to go there, but it's just how I work with my risk to reward on buying mentality. Right now, more of a small dollar cost average because I do believe the market opportunity is still a market beater, but the risk and reward is not on my favor just yet. Now I'm going to talk about CoreWeave and would love to know about some of your price targets here. Now I'm going to talk about CoreWeave, but if you guys are enjoying the episode, make sure to hit the thumbs up, the subscribe button, check out the pinned comment for a lot of great special offers I have for you, the viewers. Now CoreWeave, like we saw, past 5 days down roughly 10%. It's crazy. And from its year-to-date high, the stock is down roughly 31%. Now, this is a stock that we got into the 40s and we sold our way up to the 180s. And we recently repurchased again here in the 90s to 100. Now, CoreWeave, one of the biggest failures right now is that CoreWeave acquisition of Core Scientific is not going to go through. And this is creating a lot of, in my opinion, bearish sentiment that's not needed. Now, Core CEO says the following: the Core Scientific is not a need to have as shareholders oppositions to deal rise. It's a nice to have, not a need to have. And I think that is extremely true. I said that before, the CEO has said it himself. For those that are not familiar, the CoreWeave acquisition is they're acquiring a PowerShell company to have a lot more AI infrastructure. Now, many people look at this deal and it's an all stock deal. It's an all stock deal, right? You're going to pay about 0.1235 CoreWeave share per Core Scientific shares. Now, this deal will eliminate about $10 billion of future lease overhead to be paid for existing contractual sites. And it's also estimated a $500 million of fully ramped annual run rate cost savings through Streamline by the end of 2027. Many people see that $10 billion that, hey, look, if CoreWeave buys this company, they're going to save $10 billion. Not necessarily true. They're going to save $10 billion on the lease contracts, but that lease contract still has the cost of powering the data centers, of maintaining everything, paying the bills, paying everything, right? So all that is still there. So the company still have to pay a lot of billions of dollars. It's just it no longer would be in that lease contract, right? Because they're not leasing it over there, but it's not going to go to zero. I believe it'll still be very similar to where it's at right now. The other thing is CoreWeave already has a lot of Core Scientific's contract available to them. So all these PowerShells that they're having, CoreWeave already rented a lot of them out. Now, what you're really going to end up saving is the synergies of having both two companies. You're no longer going to pay that middleman fee if it goes. And they mentioned it's estimated about $500 million of an annual run rate by 2027. Now, to me, it doesn't make sense for CoreWeave to increase their price by, let's say, an extra few $billion if per year you're only saving a few $100 million. The math doesn't math, especially if you already have the contract wins for them. And they're expanding with other players, right? CoreWeave Galaxy just recently reported earnings, and CoreWeave has a major contract with them as well. So I agree that it's a nice to have, not a need to have. And if it doesn't go through, I don't think CoreWeave investors should worry. I actually think Core Scientific shareholders want that deal to go through because you're going to get shares of CoreWeave, a company that's going to be able to grow and have the opportunity to be a multi-bagger, right? That's a great way, in my opinion, of us asset of Core Scientific. Because a few years from now, when power constraint is not a major issue, what's going to happen to those power shell companies? Are they going to be valued as highly as they are right now? Again, as a core, if I was a Core Scientific shareholder, I would say, look, take this, take it off my hands and give me an asset that I believe can grow from here. Now, CoreWeave, we're going to look at some great charts here from CoreWeave. CoreWeave continues to increase their RPO. They recently announced two major deals, one with Meta Platforms, one with OpenAI. In a recent kind of timeline, I expect their Q3 RPO to be closer to $50 billion versus the $30 billion that they gave us last quarter. They have massive amount of power. They have 2.2 gigawatts of capacity that is coming online, 900 megawatts expected by the end of 2025 in operations, and the other 1,300 contracted capacity where they can build. This is the biggest one of that can build the biggest AI infrastructure and has a lot of power. No one, in my opinion, can compete with CoreWeave right now. Now, in forms of price action, let's just look at CoreWeave really quickly. Now, CoreWeave, I mentioned a little bit where my thought mentality is small dollar cost average, medium dollar cost average, and heavy dollar cost average. For me, for CoreWeave, I would be more of a heavy dollar cost average below $100. Now, a medium would be here between that 100 to like that 115, and more of a small dollar cost average, it would be anything above that 120. Now, obviously, as you start to get closer to like maybe that 116, it's not a perfect number. As you start to get closer to the low 120s, to the high teens, it could get a little bit more aggressive for my taste. Luckily for me, CoreWeave is a massive position in my portfolio. I don't need to dollar cost average into right now. I think for me, I would be more inclined if we ever hit 100 or in the low 110s. Anything above that, I'm personally not going to be buying. If I do, it's going to be very, very little. So those are my thoughts on CoreWeave and when I would be pushing. Long term, very bullish on this stock. I do believe this is a $200 billion stock in the next 5 years. So from here is over a 3-bag or closer to a 4-bag, right? Those are my thoughts 5 years from now with the AI story still intact. It can all shift with the AI story. And that's why you need to subscribe to this channel, because we're making sure the AI story is still intact. But if the AI story is still intact in 5 years, I do believe this could be a $200 billion player. Now, the final stock is Nebius, and this is one that I'm actually pretty excited for right now, 104. Now, Nebius, we can see by end of 2025, they're expected to have roughly 220 megawatts of connected power. By the end of 2026, they're targeting about 1 gigawatt of power. So they're growing, right? They're building massive infrastructure. On September 8th, they announced that massive multi-billion-dollar deal with Microsoft. They recently announced that they're building a small data center in Israel, deploying, being one of the first countries of the country's first AI infrastructure deployment. You're seeing them expanding a little bit more. And they also just raised a nice amount of money, nearly $4.2 billion in forms of equity, dilution, senior notes, and selling of shares. That gives this company the opportunity to grow that power needs and AI compute dramatically more. Nebius is the second, it's nowhere near the size of CoreWeave. It's a lot smaller than CoreWeave, and maybe that gets me a little bit more excited. But for Nebius right now, I actually did very similar. Here, closer to, as we get to the low 100s, it becomes kind of like a medium dollar cost average. Right now, I would say still more of like a low dollar cost average. I'm actually thinking of selling puts around these levels. Maybe I'll selling puts at below 100. I believe I can probably get like $5 premium or something like that. And if it goes below 100, I get the stock at $95 in true cost. If it doesn't, I get the premium. I'm still happy with my positions. I think for companies like Nebius and CoreWeave right now, the selling of puts is probably one of my favorite methods. Now, options are pretty tricky, not something I would recommend with anybody. I typically just do more of just vanilla shares. And to me, anything above 100 is low dollar cost average. Except right now that we're in the low 100s, I wouldn't mind doing more of a median cost average either. Anything below $80 would be a heavy approach. Again, this doesn't mean we're going to get to those levels, but this helps me think of when I want to go heavy, when I want to go small, when I want to go medium size. And right now we're getting closer to that median size. And because of that, I really don't mind the selling of puts. Now, I hope you guys enjoyed today's episode.